G'day everybody. Today's talk is going to be inflation by design, how central bank policies serve the interests of federal governments. Imagine you have a basket of 10 apples that you've grown in your garden. There happen to be 10 people in your village who want to buy one apple each. You charge them $1 per apple because it costs you 50 cents to grow the apple, another 20 cents to bring it to market and package it and wash it. So you make 30 cents an apple, which is okay. But suddenly, there are 30 people in the village who want to buy one apple, and they all have different levels of income and standard of living. Suddenly, one individual bids 5 times what you were previously asking for the apples and walks away with all the apples. He's just established the new floor price of apples at $5 per apple. You accept because it's the highest bid, and now you're really making money. You're making so much money, in fact, that you decide to speculate on crypto from now on instead of growing apples, which is a lot of hard work. The price of apples in the village has now been established at $5 a piece, but the village has grown by another 30 people. So the village leaders decide to print more money because the poor people have started to protest because they can't afford apples anymore. The village leaders distribute the printed money to the village bankers, who then lend it out to the entrepreneurs at nominal interest. None of the money filters down to the poor, who can now no longer afford apples, the land to grow it on, or even the apple seeds. This is the essence of inflation of the monetary supply, followed by price inflation of consumer goods. This is the era in which we live currently. There is no other possible outcome of quantitative easing than price inflation. So it is central bank policy since 2008 that has led to this inflationary environment in 2022. There's absolutely no value to point out that we at Midas have been essentially screaming from the rooftops for years that the only possible outcome from quantitative easing by central banks is rampant inflation. But this is simply because of the following equation. Monetary inflation equals price inflation later in the timeline. Simply put, the unbridled fabrication and distribution of dollars through central bank quantitative easing, which forms the capital base against which loans are made by banks, results in an exponential expansion of the global liquidity pool at a rate which far exceeds the ability of the human economy to generate real assets at the same pace. Coupled with low to zero interest rates, which are the moderating factor in loan demand, the liquidity pool explodes, creating competitive demand for all assets, real and synthetic. Corporations rely on low interest rates to buy back their stock, which drives their share price higher through fewer shares, thus inducing a positive share price appreciation. So we get more money in the system chasing a finite pool of assets, resulting in bidding up of the assets as competition for acquisition of control of them is simply controlled by the arithmetic. Whoever bids the most wins the prize. This is what is happening. This is the core of the inflationary event we are in right now. And as we have indicated since at least 2012, the inflationary pressure can be distributed and kept nominally invisible in a financial system that is constantly creating new instruments to absorb the expanding liquidity. So all of these fancy synthetic assets, including cryptocurrencies, which would in a normal monetary phase would not be permitted because they have no actual tangible value, they are permitted and encouraged because they are avenues to absorb the excess liquidity created by the government. The explosion of synthetic assets, those which have no tangible existence, since the beginning of this century, is essentially the result of collusion among the central banks, governments, and oligarchs who influence them to relax the rules so that there are more assets to buy. When the rate at which synthetic assets are created falls behind the rate at which the multiplier effect of quantitative easing is increasing the liquidity pool, prices of tangible assets, commodities, real estate, capital goods, must rise until the price tempers the demand. And this has come to pass. Yet those of us who recognize the pattern and tried to call attention to it over the years have now been relegated to shadow banned obscurity as Google incessantly tends to throttle the public discourse to align with government-sponsored messaging. And so it is that we arrive in the current situation where the mainstream, Google and government-anointed press claims that the market is improving because interest rates and dialing back stimulus or quantitative easing is good for markets. Such a glaring example of Orwellian doublespeak has never been witnessed. There can be little doubt that the Tier 1 beneficiaries of quantitative easing have now been tasked with buying extraordinary blocks of major U.S. index futures, as can be deduced by the strange and counterintuitive volumes in those instruments prior to Fed announcements. Again, these prognostications and theories will go largely unregistered by the utterly rotten financial system and media because the investing public is now force-fed only sterilized, Fed-approved messaging from the likes of talking heads on CNBC, Bloomberg, Wall Street Journal, CNN, who, through the limitations of journalism, can only report on the data they are presented with by the Fed, the Treasury, etc. They are led around by the nose without realizing it. Be that as it may, it behooves us of modest means and ambition to protect ourselves as well as possible from the onslaught of verbal satellite debris designed to confound us into a passive stupor where we hand over our savings into the machine for shredding. The Fed has issued statements suggesting the rate at which interest rates will be increased will be more intense than transmitted back in October 21. But this is merely the Fed trying to use the force to get us to do its bidding. I.e., don't bid up commodities, buy bonds, keep buying real estate, keep investing in the stock market. These are the worst places to be for retail investors, especially real estate now. Real estate prices have inflated so badly through this effect of creating competitive demand through monetary expansion that the prices are not supportable. And in a high interest rate environment, those prices are going to retreat. The price action of residential real estate is the purest example of the phenomenon whereby monetary inflation always precedes and then drives price inflation. The rising prices of the asset class due to more demand entering the market than supply can be created is the very essence of economics 101. But just as is taught in cyclical economic theory, the result is always an oversupply as soon as the supply side catches up, which induces a flattening of prices ahead of a retreat, as the fear of missing out, FOMO, sentiment is replaced by the don't catch a falling knife mindset. With the Fed's back firmly against the wall here, it has no choice but to raise interest rates, the gasoline on the real estate fire, in an effort to marshal the lesser of two evils, higher borrowing costs over higher consumer goods prices. But the Fed and central banks around the world are about to discover the unfortunate kernel of truth in their financial bulimia scheme. The financial system will not respond in the way the Fed wants it to just because it raises interest rates. That's because raising interest rates does not decrease the liquidity pool immediately. It takes time through the retirement of central bank facilities to dial it back in. Instead, the volatility of the markets will increase, and the Fed's attempt to shore it up through induced asset purchases in the index futures market will only temporarily assuage the overcapitalized investor pool. The problem here is that the most aggressive investors, just as they did in 2008, will begin to short the market, knowing that without the twin stimulants of low interest rates and quantitative easing, there is only the possibility of asset price contraction as sell-side participants begin to overwhelm any artificial buy-side support. Economists like to point to business cycles to feed optimism that allows us to go about our day under the threat of financial storms. These business cycles are highly misleading because they presuppose certain constants to remain in place, like infinite commodity supply from nature indefinitely. But we are now at or near peak production of everything from oil to lithium to fish to timber, and since all is derivative and dependent of the primary extractive industries, the convergence of population-driven demand with resource depletion is about to impart its ultimate catastrophic influence. The business cycles are dead. The production of the planet is maxed out. The economic recession on the horizon is about to arrive, and social friction generated by wealth disparity is about to rise to critical levels. Already, grocery stores are looking lean in the developed world, and technology is no match for the intensity of the ecological correction about to unfold. The government's interest in eliminating debt is served by higher inflation and rising interest rates. This is called financial repression. And if you'd like to learn more about it, read the dissertation by International Monetary Fund economist Carmen Reinhart. As she describes it, financial repression occurs when governments implement policies to channel to themselves funds that in a deregulated market environment would go elsewhere. Policies include directed lending to the government by captive domestic audiences, i.e. primary dealers, who basically buy 70% of the auctioned Fed treasuries, such as pension funds or domestic banks, explicit or implicit caps on interest rates, as we've experienced over the last 10 years, regulation of cross-border capital movements, and generally a tighter connection between government and banks, either explicitly through public ownership of some of the banks or through heavy moral suasion. The moral suasion exists in that if you want to be a primary dealer at the Fed auction table, you are compelled to purchase and place bids for the treasuries to maintain your status as a bidder. That is as overt as moral suasion gets. If you want to learn more about financial repression, you can visit Carmen Reinhart's work at these links. I highly recommend it. It is very illuminating. She wrote that back in 2011. Talk about insight. Anyways, send me any questions you might have about this, jwest@midasletter.com. Thanks for watching.